Hello everyone, welcome to SFC Exclusive. In the first half of 2024, the US Federal Reserve's monetary policy continuously attracted market attention. The European Central Bank initiated its first rate cut since 2019. Meanwhile, in China, macroeconomic policies constantly supporting the economy. Looking ahead to the second half of the year, what will the global economic landscape be like? What factors will bring new growth momentum to the global economy? What role will China play? We have invited Adrian Cooper, CEO and Chief Economist of Oxford Economics, to discuss these questions with us. Hello Adrian, welcome. Midway into 2024, do you think the world economy is stronger than we expected at the beginning of the year or vice versa? Why?
Okay, so the world economy has slowed over the course of the last 12 months, and that's not a surprise given the increases in interest rates that central banks around the world have introduced. But I think that slowdown has actually been a little bit less marked than many commentators anticipated. In particular, there are some people who feared the world economy might go into recession as a result of tighter monetary policy. That was never our view at Oxford Economics, but I think it's probably fair to say the world economy has actually been even a little bit stronger than we anticipated. And I think that is a reflection in particular of support that both the US economy and the Chinese economy have got from looser fiscal policy.
It sounds like there are very good signs for global economy. Also, as you mentioned, major central banks around the world, such as ECB, are now leaning towards lowering interest rates. What changes will this bring to the global economy for the remainder of the year?
Yeah. So headline inflation is down sharply, and we've seen central banks like the ECB start to cut interest rates. And I think more generally, central banks are going to be somewhat cautious about bringing interest rates down because they're going to want to make sure that core underlying inflation is also coming down to target, and that's proving a little bit stickier given continuing significant increases in wages in many countries. But I think if we see interest rates fall through the second half of this year, in particular, that's going to be good news for supporting consumer and business confidence, and that will help to strengthen the prospects of recovery in 2025. Although I would stress that I think that the pace of that recovery next year is likely to be relatively cautious, even with lower interest rates.
Meanwhile, the Fed still keeps the rate high, and US inflation appears to be more persistent than expected. What is your outlook for inflation? Do you think the Fed is acting late or being extremely cautious?
So we've seen, again, in the US, headline inflation coming down sharply, and core inflation is down, but it's still above the 2% that the Fed would really like to see. And I think that's a reflection of the fact that wage growth is still relatively strong, particularly compared to productivity. So unit labor costs are increasing, especially in the service sector. I think that as well, the Fed is looking at the strength of the labor market in the United States, and so kind of doesn't feel in a hurry to need to bring interest rates down to offset a potential significant slowdown in the economy. So they're going to be very data driven. They're going to be pretty cautious in when they move. They want to make sure they've got inflation linked. But I do think it's likely that we will see one or two cuts in interest rates through the second half of this year, and then more cuts through 2025.
Why the ECB is acting ahead of the Fed?
Yeah, so the situation for the European economy is somewhat different to that of the United States. In particular, I think the European economy is significantly weaker in terms of its growth performance. It's held back, for instance, by things like high energy costs. They may have come down from their peaks, but they're still high by international standards. That's undermining the competitiveness of important aspects of European manufacturing. And I think too, factors like tightening in fiscal policy to meet fiscal rules is also likely to be a factor that holds back growth in Europe too. And therefore the ECB is having to respond to a weaker underlying economy than the Fed is facing. And I think that means not only if they move sooner, but they're actually going to be cutting interest rates more quickly than the Fed over the course of the next year.
Is it possible that we will see no Fed cuts in 2024? If so, what impact will it bring?
Yeah. So I think it's more likely than not that we'll see at least one cut in interest rates in the US this year. But it really does depend on what we see happening in terms of underlying inflation and the continuing pace of growth in America. If we weren't to see a rate cut, then I do think that would hold back the improvements that we've seen in consumer and business confidence in the States, and is likely to mean that the recovery next year is less robust than we're expecting.
So what can we expect from the US economy in the months ahead?
A lot of people have been worrying that the US economy is heading into recession. And certainly there have been some survey indicators that have been less robust. However, I think overall, actually, the US economy is in pretty good shape, particularly when we look at what's happening within the labour market, where employment growth remains healthy. We're in a situation where households are seeing significant improvements in their real take-home pay as wages rise ahead of inflation. And business investment is being supported, for instance, by measures like the Inflation Reduction Act, which is encouraging companies to invest in the US. So I think overall, we're likely to see the US economy growing sort of around its trend rate through the rest of this year and into 2025. I don't see sort of big changes in momentum in the American economy.
So the US economy can achieve a soft landing?
Yeah, so I think it's very much a soft landing that we're seeing within our forecast. So growth staying around 2% or so, while inflation through the course of 2025 comes back to the Fed's targets on an underlying basis. And I think it's that underlying strength of the US economy, the innovation that we're seeing, as well as the strength of household and corporate balance sheets, and the fact that we're seeing household incomes rising in real terms, that will keep the economy rolling on, despite this high level of interest rates that it's been operating under lately.
With what you just said, should we be worried that the US election might cause more uncertainties to the US and the world?
I think the implications of the US election are an important risk to the global outlook, particularly if President Trump is given a second term in the White House and proceeds to implement some of the trade protectionist measures that he's been talking about. Some of these are really quite significant: 60% tariffs on imports from China, 10% tariffs on imports from other countries. That could really trigger a global trade war, which would be damaging actually for the US economy as well as for the world economy, particularly as countries retaliate to those protectionist measures from President Trump. However, I think the short term growth may be boosted under his presidency by looser fiscal policies than we otherwise would see. I think it's also worth remembering, when we talk about increases in protectionism, that actually President Biden has introduced a number of measures that are more protectionist too. And I do think that whoever's president, it's likely that we're going to see more restrictions on trade after the presidential elections and over the course of the next few years.
Speaking of uncertainties, we saw right-wing parties gain ground in the 2024 European Parliament elections. How might these election results influence EU economic policy?
So I don't think we should exaggerate too much the implications of the European elections. Clearly, the far right did relatively well, but we still see the centrist parties in control of the European Parliament. I do think, though, that the success of the far right will lead to greater focus on security, on industrial policy, and on trade policy. And we've already seen, for instance, recently action by the European Union in terms of putting tariffs on certain imports from China. I think the situation in France is potentially more worrying. We yet to see the outcome of the second round of elections, and whether actually the RN has a majority in Parliament. I think there's a real danger in the case of France that we see a kind of policy paralysis, and that would, for instance, delay some of the measures that are necessary to move French fiscal policy back towards the sorts of targets that the European Commission requires.
How do you assess the recovery of the European economy?
I think that the political uncertainty that sort of building in Europe is not something that's necessarily helpful in terms of consumer and business confidence. So I think in that sense it may be a little bit of a drag on growth, but there are sort of more fundamental challenges too that Europe faces in terms of its competitiveness and its demographics. That said, I do think that the fall we've seen in headline inflation, the fact that we're now seeing workers' wages rising faster than prices so that their spending power is improving, will actually be more important in terms of the momentum of the European economy over the next 12 months, and will lead to some improvement in the rate of growth compared to what we've seen lately. And that obviously will be helped too by European Central Bank continuing to bring interest rates down.
What are your expectations for China's economic performance for the rest of the year?
Yeah, so the Chinese authorities have set a target for growth around 5%, and I think they'll get close to that. But that's very dependent on stimulus that the government has put in place, and I anticipate that we'll see some more stimulus measures too to make sure that the growth target is achieved. I think the challenge for the Chinese economy is those stimulus measures, they may not be as focused on property, on real estate and construction as historically, and more focused on some of the new industries like electric vehicles and renewable energy. But they're still very focused on investment rather than trying to grow the consumer side of the economy faster. So I think that getting growth around 5% this year is perfectly achievable. But I think looking longer term, the growth model does need to change. And
overall, what do you think are the biggest challenges facing the global economy?
Well, I think that first of all, we need to complete the disinflation process. We've been through these massive period of very high inflation. It's important that central banks are seen as being successful in bringing inflation back to target and rebuilding their credibility. I think secondly, we have the whole challenge around geopolitics and, from an economics point of view, particularly challenges around increased protectionism that are not helpful in terms of the world economy retaining momentum. And then I think, on the other side of the equation, I think it's really important to remember that there are things that could mean the world economy does better. And in particular right now, some of the technological innovations that we're seeing associated, for instance, with things like artificial intelligence could lead over the course of the next few years to important improvements in productivity, which help to bring the world economy back onto a faster growth path.
You mentioned AI. Many people believe that AI will become a new growth driver. What's your take on that?
Yeah, well, it's really important that the world economy does find a new growth driver, because the demographics, the aging of populations mean that we're not going to get much support to economic growth coming from increased labor supply over the next couple of decades. So growth is going to be even more dependent on productivity than it has been in the past. Now, we've done a lot of work at Oxford Economics about the potential impacts of artificial intelligence, looking particularly at the US and how AI could affect the different tasks that make up people's jobs. So we've sort of asked, to what extent could artificial intelligence help people in certain tasks To what extent could it actually replace the need for a person to do those tasks, or what are occupations where AI won't be very relevant at all? And we've then asked to what extent will companies adopt AI over the coming decade, and we've looked back at experience, for instance, in the take-up of enterprise software in the US in the 80s and 90s. And then we've asked about, well, what will happen to those people who lose their jobs as a result of AI? And when we take all these different factors together, our central estimate is that generative AI could perhaps add as much as 3% in our central case to US GDP over the next 10 years. If it does, that would be really quite a significant change in the underlying trend rate of growth for the US. And I think we'd see similar patterns across lots of other economies as well. Probably not going to have a big impact in the next couple of years. It's more looking 5 years and further that we'll see those impacts really coming through. But I think AI does offer quite a lot of promise as a new growth engine.
So what role will China play in the AI sector?
Yeah, well, we're seeing the Chinese authorities and Chinese companies being very active in investment in AI. I think that really trying to be at the forefront of those developments, and investing as well very heavily in things like the development of semiconductors are going to be critical to those technologies. So clearly, there are challenges, particularly given the restrictions on the availability of frontier semiconductors from the West to Chinese companies. But I would anticipate that China will ultimately be one of the leaders in the AI race.
Given the current market conditions and geopolitical landscape, what advice do you have for global investors?
Yeah, I think that our forecast for the world economy is one where we do think we're going to see growth picking up gradually over the course of the next year. It won't be a rapid recovery, but the world economy has proven to be pretty resilient. So I think we're at Oxford Economics still overweight risk. We tend to favour, for instance, equities, and particularly emerging market equities where valuations have been relatively low. We're also favour things like high yield credit, and possibly as well smaller cap companies compared to large companies as the global cycle improves. But clearly there are significant risks, particularly around protectionism, that investors need to be very mindful of.
Thank you, Adrian. As Adrian mentioned, there are always some factors such as technological innovation that will help to bring the world economy back onto a faster growth path. And China is really trying to be at the forefront of these developments. That's all for today's show. Thank you for watching. See you.